Welcome to the Leaders Insights podcast. Today's episode, Hedging FX and Rate Risk Without Gambling. What the consensus gets wrong. The euro just punched through 1.18 against the dollar this week, and I've watched 3 CFOs on LinkedIn brag about the hedges that saved them. You wrote today that most of them are basically gambling. Explain yourself.
Happy to. When the euro-dollar rate moves 5 cents in a quarter, everyone who bought a forward contract, an agreement to lock tomorrow's exchange rate today, suddenly looks like a genius. But looking smart after the fact isn't a strategy. Half those teams hedged exposures that didn't need hedging and paid a premium to sleep better. That's not insurance. That's paying for a feeling.
Hold on. Isn't that exactly what Treasury is supposed to do? Remove uncertainty?
No. Treasury is supposed to protect the business from moves that would actually hurt it. There's a difference. If I'm a European exporter and 40% of my revenue is in dollars, a weaker dollar genuinely dents my margin. Hedge that. But if I've got a small dollar receivable due in 3 weeks against a big dollar payable in 4, those two roughly cancel. The consensus buys a forward on each leg anyway, pays the spread twice, and calls it discipline.
So the sin isn't hedging too little. It's hedging things that offset each other.
That's the most expensive one, yes. It's called gross hedging instead of net hedging, covering every exposure individually instead of the leftover after they cancel. I saw a mid-cap industrial last year running 200-plus forward contracts across 11 currencies. When we netted the exposures, their real risk was about a fifth of what they were hedging. They were paying banks roughly 800,000 euros a year in bid-offer spread, the gap between the buy and sell price the bank pockets, to hedge risk that already netted itself out internally.
800,000 to protect against nothing. That's a great slide in a terrible quarter. But surely someone signed off on that.
Everyone signed off. That's the problem. Nobody gets fired for overhedging. You get fired for the one time you were exposed and it went against you. So the incentive is to smother everything, and the cost hides in 100 small spreads. Nobody adds up. My rule? If you can't name the P&L line a hedge protects and the size of the hit if you don't hedge it.
Let's talk rates, because that is where 2026 got interesting. The Fed's held around 4% and the ECB's drifting lower. Doesn't that divergence force your hand?
It tempts your hand, which is different. When U.S. rates sit above European ones, the forward market makes hedging dollars into euros look almost free. Sometimes you get paid to do it through the interest rate differential. And that's precisely when people overhedge, because it feels cheap. Cheap isn't the same as necessary. I'd rather carry a small, understood, open position than lock in a hedge just because the carry flatters me this month.
You're describing deliberately staying exposed. A board hears that as recklessness.
Then reframe it for them. Every unhedged euro is a decision, and every hedged euro is also a decision. Both cost something. The reckless move is pretending hedging is free. I tell boards, here's our net exposure. Here's the worst plausible move. Say the dollar weakening 8% based on the 2025 swing. Here's the euro impact, and here's what full coverage costs versus covering the top 70%. Then they choose with numbers instead of nerves.
One vendor stat I keep seeing, Kyriba claims companies misforecast their FX exposure by double digits. Do you buy it?
Kyriba sells treasury software, so take the exact figure with salt. Why ain't? They're incentivized to show you're flying blind. But directionally? Yes. Most exposure forecasts are stale spreadsheets updated monthly, while the business moves daily. You can't hedge intelligently on numbers 3 weeks old. Fix the forecast before you touch a single derivative.
Give me the one thing a treasurer does Monday morning.
Pull every open hedge, group them by currency, and net the opposing positions. Whatever cancels out, unwind or let expire. You'll typically find 20 to 40% of your book is protecting risk that was never there. And that spread comes straight back to the business.
Done. Want to know where you actually stand? Take the CFO self-assessment at mba-training.com.